Hi, I'm Lindsey Moore, and welcome to my podcast, In Conversation with SMEs. I'm the founder of Agnes Marketing, and we help professional services businesses to win more clients through strategic, organised, and effective marketing. The purpose of this podcast is to provide motivation, inspiration, and advice to people who are wanting to start, scale, or pivot their business by hearing the stories of others who have been brave, kept their nerve, and achieved something quite remarkable. Enjoy. In this episode, I speak to David Malone, corporate lawyer at O'Connor's, and Simon Mills, chartered accountant and corporate finance advisor at Langtons. David and Simon are both business owners, but the reason I wanted them on the show together today was they advise businesses at all stages of their growth journey. So I wanted to speak to them about the common pitfalls that face business owners who are going through the process of growing their business. And I wanted to ask them, what are the most common challenges and opportunities that are faced by business owners, and how can they maximise them opportunities and limit the risks to ensure that they grow sustainably and well. And I can't wait for you to hear what they have to share. Dave and Si, hi. Thank you for being here. It's really great to have you here today. I'm just going to ask you to, first of all, to introduce yourselves. Si, if you want to go first.
Absolutely. So Simon Mills, I'm corporate finance partner at Langtons. Langtons are a chartered accountancy practice based in Liverpool. My specialism is corporate finance and mergers and acquisitions. Been with Langtons for 17 years, so a reasonable amount of time, undertaking buy-side, sell-side transactions and helping businesses grow and raise money through their growth phases and through to through acquisitions, exits, etc.
Brilliant.
So that's kind of my background.
Si. Dave, hi.
Hi, David Malone. I'm a corporate lawyer at O'Connor's Solicitors. We are a Liverpool-based law firm, 20 years old. I've been there for 17 years as well.
Oh gosh, same amount of time?
Yeah, from trainee. I'm a corporate lawyer, so in a sense where Simon does everything from the kind of financial side on a merger or acquisition, we're looking after the legal side.
Okay. Thank you for that. And like the $1 million question that I am constantly fascinated by is, how do you go from a business that could even be like a sole trader or a micro business, and you'll have seen growth in the clients that you've advised over the years, to an SME and beyond? How do you grow something from nothing, and what do you have to really keep a close eye on in order to be able to sustainably grow a business?
I think there are two parts to that. One is obviously the growth part of typically the businesses that I see that come from that very early sole trader or low revenue business to a SME, owner managed business, maybe private equity backed. That they need the market, they need an opportunity, and they need good leadership. That's the critical part. But I've seen lots of good businesses with good leaders, good owners fail or not hit that growth because as they go through that cycle, as they go through that business life cycle, that business maturity piece, they don't add in the critical parts of the operational side of the business and the financial side of the business that they need. So that's simple things, or to me simple things like management information, making sure they've got time information, forecasting, making sure they understand what's coming down the track, and trying to box off business risks as they come onto the horizon, cash flow management, and being ready for each of those stages. There's typically a requirement for investment. So that might be investment in kit, it might be investment in people or locations. As you go through that life cycle, you're gonna need funding, you need money, whether that's money coming from the profitability you're making, or whether that's money from an external source. But you need to be ahead of that and not reacting to it, and be a proactive. In my view, the successful businesses are the ones who have set out a 5-year business plan, and understand what that journey could look like?
I think it's important to say that a lot of the time it's fair to say we would see businesses fail or struggle because they run out of cash.
Absolutely.
Right.
Not that they're not good businesses.
Yeah.
So a lot of the points that Simon's making around having the structure in place or maybe second guessing or forward looking at what the issues that they might face and dealing with them as early as possible will put them in a very good place for that growth.
Absolutely.
Yeah, because you mentioned management accountants, advice and information there. And it's funny as a business owner, isn't it? You can be so consumed in the now and the here and now, because you're up against things on many fronts, trying to, service your clients and your customers, that obviously as a business owner yourself, taking a step back and being able to sort of horizon scan and forward plan is important. But I think for a lot of business owners, like anybody, you don't know what you don't know. Yeah. So can you just give us a bit of context and some examples of the where businesses that you advise have got access to information that has made all the difference to them going forward, and what management information is really and the power of it?
So typically, as you said, they're business owners, and especially at a smaller scale, they're looking and they're focusing on what they're doing. They're focusing on their customers and their products. They're not necessarily focusing on the financials. So, management information is, and again, these things grow as businesses grow, but typically you're looking at monthly information. So most businesses will have, and most people listening will have businesses with, some sort of accountancy package. It's getting the relevant information you need out of that to understand what is driving your turnover, what is driving your profitability, what is driving cash generation. Mm-hmm. Being able to look at that on a timely basis. So, shortly after each month end, so you understand what's happening. That obviously frames the past. That frames where you are as a business, where you are in that on that journey. Dave just then talked about planning and looking forward. I talked about a 5-year plan, putting things into a forecast, looking at where the business could be, planning out, that growth journey you're on, and the cash you need to complete that journey. That's a valuable piece as you get to certain scales. Number of businesses I've worked over the years, we've had those, or they've had those systems in place. We've helped them put those systems in place. So they might have a financial controller in-house doing those management accounts month to month, and then maybe we've come in to help put a longer term forecast in that's being used monthly, quarterly, updated, so that they can see where they are on that journey and looking forward to how does my cash balance look in 2 months' time, 3 months' time, a year's time, looking at some of those cash things like corporation tax payments, payments on loans or purchases for equipment that they might need to make in the future. That's helped businesses as you're going through that journey to be ahead of the curve. So they know, for us to continue on this path, we need another production line, as an example.
Okay.
So we know that's needed in 6 months' time. We need to start planning now. We need to start ordering this and funding this and paying for this. Yeah. Rather than we haven't got any capacity, we need a production line. It's going to take 6 months to put in. Yeah. We might lose customers and opportunity because we weren't prepared.
Yeah.
I think the other thing to add to that is that in doing that planning, it very often puts you in a position that when you are then looking for funding, if that's external, third party, traditional bank funding or private equity funding or whatever it is, you've got that, almost that starting structure of what's the presentation going to be? Why do we need it? What's the justification? Yeah. And starting that process earlier and talking to those funders earlier is a key part of that process, rather than getting to a point where you're just about to fall over and you need the cash and then you're talking to a funder, because it's a very different conversation.
Absolutely.
Because you need the money and the timing's tight.
Absolutely.
Yeah. What would you say then is the most common outside of the having obviously healthy accounts and the ability to make timely decisions based on management information, Dave, what, from the legal side, what do you see as a common, maybe a pitfall or challenges, or as advice of these are things I see happen regularly and you should probably avoid them in order to not run into trouble further down the line?
Yeah, I think very often where we come into contact with businesses, probably two separate situations. One is if they're on a journey of looking for investment or acquisition, and we're working alongside Simon and his team to put something together which is actually really positive and future facing. The other, sadly, is when something's gone wrong.
Okay.
So in the growth stage of businesses, we've seen plenty of businesses where they've struggled because they haven't looked at some key issues or key risks, as I'd put them. First one is a shareholders agreement, or what happens when you give shares away and you don't have an agreement in place that kind of governs that. And the other would be around the actual terms and conditions of your trading, and making sure that you're actually concentrating on what agreements you're entering into and what the impact of those are. So if I deal with the shareholders agreement point first, and I'm stealing the lines of a good friend of mine who's a divorce lawyer, who said to me once, Dave, problem is 100% of divorces start with a marriage, and very often I thought, well, actually that's relevant to businesses. You might have a couple of people who start in a business, they've got a great opportunity, they're looking forward and it's really positive, but what happens when that goes wrong? And sometimes further down the line, it's, a couple of friends who've started a business 50-50. So it's completely deadlocked and you can't make decisions without the other person.
So what do you mean about that? Because a lot of people will go into business with a partner or with their friend, and they'll go, okay, we're 50-50. Why would that cause an issue further down the line, potentially, if they decide to go their separate ways, or if they fall out?
If they fall out, it means that you can't make decisions very easily. So if you were talking about it from the board of directors, if there's two directors and they are the directors, then if they've fallen out quite fundamentally, then one will not agree to what the other one wants to do.
Yeah.
That same at shareholder base as well. If you've got two shareholders, you couldn't make a decision to change the way that you were going to operate without the other's consent. So very often we have seen extremely good businesses and very valuable businesses almost lose the value overnight because the business can't trade because
you mean one business owner wants to make a strategic decision that the business goes in that way and the other one doesn't agree.
Yeah.
And therefore they're sort of pulling against each other.
There's a complete impasse.
Yeah.
So what happens in that situation then? How do you get out of that situation?
Well, if anybody's ever read Bleak House, it's a bit like that, where you can end up in very, very long legal litigation, where the only people who actually do well out of it are the litigation lawyers. So in those situations, you're often looking at how can you split a business so that people can go their separate ways, but often it's acrimonious, so they're not going to want to agree. So
it is like a divorce, basically, splitting the assets.
Yeah, and both parties will think the other one's trying to do them over in a way. So
how would you, if you're going into business with a partner, then how do you avoid that happening?
A shareholders agreement is a great starting point, which is effectively a contractual document between the parties, the two shareholders and the company, as to how they're going to operate the business.
Okay.
So, really successful businesses often will have a shareholders agreement, which just gets put in the filing cabinet and never looked at.
Right.
But if there are issues that come up at some point, there's a contract which gives you the framework of how that's going to work.
So it's like equivalent of a prenup. of a marriage.
Yeah.
Okay, so
yeah,
it's okay.
Absolutely.
Using your analogy.
Yeah. So often that will say, well, who are the directors going to be? How are we going to operate the business on a day to day? What happens if one wants to sell? Can we take the other shareholder with us? How are we going to deal with dividends?
Okay.
So there's all sorts of things that will be dealt with in that contract. And because that's been set out at a very early stage, then there's ways of flowing through that so that if there are issues in the future, at least the business isn't going to suffer, or you hope that the business isn't going to suffer.
And
I was just going to say that, I mean, Dave made a very valid statement there, is, many businesses just take that agreement and put it in a drawer.
Yeah.
But as you go through that growth phase, it's also worth bearing in mind, if it's two people who've started that business, as you go through there, you'll undoubtedly add people into that board of directors. You'll add people into that shareholder base as you grow the business.
Yeah.
So whilst it's great that hopefully that document never comes out of a drawer, when you add people, my advice would also be actually take it out of the drawer and revisit it.
You mean as you make them like an owner in the equity stakeholder,
shareholders, and or adding directors, because there's an example of two people. You've got two people on the board. If you add a third, how does that alter those decisions that you presupposed in the shareholders agreement? So you need to just revisit it. It's great that it never gets used. So that means you've not fallen out. Yeah. But it needs to be maintained and updated as you go through that life cycle of a business.
Yeah, so we've seen examples, and again, these always sound like they're the worst case scenario, but when it happens, it looks blindingly obvious. So we've had scenarios where a shareholders agreement has had clauses in that need unanimous consent. So you might have somebody in who could be a 1% shareholder who can hold the rest of the shareholders to ransom, because if they don't agree to it, then it can't be passed unanimously. So you got to be really careful about things like that, and the dynamics that change when even bringing in minority shareholders. So the other point, yes, we got two people who are starting out day one. That's one thing, but the other thing that often happens as well with early stage businesses is almost feeling the pressure that you've got to give shares away to employees. Okay, I can't afford to pay you a proper market salary, but I'll give you some shares. Well, if you don't have a shareholders agreement in place, again, they might be a minority shareholder. What happens if they leave? How do you control having an impact or a position where they leave the business and there's no way of actually buying their shares back from them? And that then gets onto some more technical points, which we often see, which is what type of leaver are you? So if you leave to set up in competition next door to me, I don't want to pay you the value for those shares, because you're going to be you're taking my knowledge and going to be competing with my business. So in those scenarios, you might have what's called good leaver and bad leaver clauses in there, which say if you're a good leaver for these circumstances, you will get the fair market value for your shares. If you're a bad leaver, you get par value, which is the value of the shares.
And how common is it for businesses who are in a partnership, like there's more than one director or business owner, not to have a shareholder agreement in place? How common is it?
I think and it's really interesting, this scenario, because I think a lot of the things that we're talking about can sound really ideological. We were chatting about it the other day. You wouldn't say, I've got a great idea for a business, let's go and spend money on a shareholders agreement, really good management information, if we don't know whether the business is going to work or not. So the answer is, we'd say it quite often in terms of somebody's coming to see you because they've got a problem they need to try and solve. But the important point for me, if I was listening to this and thinking about starting a business, or I have a business that's operating successfully, is just questioning, okay, have I got something, and do I need something? Is the protection that I need now?
Okay.
I talked about the structures and controls as you go through the life cycle. And say, you don't need a CFO as a sole trader turning over £250,000, £500,000. When you 50, £60 million turnover business, that's when you or whenever you need it on that journey, that's when you need that type of role. You don't need a shareholders agreement on day one.
No.
Unless it's something that actually there's a high level of risk there. So it's down to the individual business, and it's, it can be quite difficult when you're talking generally and trying to put these things in. It's down to the individual business and the way it operates. But yeah, I see reasonably often businesses not having shareholders agreements, but typically the times you see it, as David said, is when there's a problem.
Yeah.
It's not, we're asked to value things for a dispute, a shareholder dispute, because there isn't the shareholders agreements in place.
So in terms of sticking on the subject of risk and trying to avoid any unnecessary risk and expose yourself to any unnecessary risk, we were chatting before this recording, and you were saying about contracts and really, how they can really come to bite you if they're not really thought through. So can you just explain a bit about typically what you see in that instance?
Yeah. So again, this is it'll all depend on the type of business you are as to what the agreements need to say. So if you start at a very base level, do you have a set of terms and conditions for the business that you're doing, and do they work? So if you're a consumer-facing business and you're providing goods or services to consumers, there's a very different kind of regulatory or statutory framework that sits around that. Consumers get more protection than businesses do. So making sure that your general terms and conditions and how you're interacting with your end consumer is very important. What you don't want to find is that you think that you've got a set of terms and conditions that protects the business, but actually, if that was challenged by a consumer, that you could ride a coach and horses through.
Right.
So, and in a similar way, if your business is contracting with other businesses, okay, there's not that same framework, but are you inadvertently accepting their terms and conditions? And
you mean
not
if you're
yours?
in, like, say, a supply chain?
Yeah.
Okay.
So there's often what's called a battle of the forms, which is whose terms and conditions take precedence in that transaction. And also, just from a general point of view of, are you actually negotiating those contracts and looking through them, or are you just accepting them as a fait accompli? So as a starting point, very often with businesses, it's a kind of like, well, if it's a David and Goliath situation, do I have the power to actually negotiate? Well, if you start from the point of view, if you don't ask, you don't get. Are there certain points that you want to push back on? The obvious one when we talk about growth of businesses, and the point Si's made about cash. Well, when am I going to get paid? So are there payment terms 120 days? And can I actually reduce that to 60, because then I'm getting paid quicker? Yeah. So just looking at some of those details are really important.
And can you give us, have you got any other examples of where else terms that areas that clients that you've advised have fallen foul of realising that actually their terms and conditions of the contract they've signed, or the contract that they had in place that they created, had gaps and exposed them to other risks? What other types of things can go wrong there?
I think it's quite a generic point that, again, we're only seeing clients who are coming for that advice at the back end when something's gone wrong. So, it's almost I've signed this contract and actually either somebody's not paying me, or, it's an onerous contract, it's loss making. How do we get out of it?
Right.
So there can be all sorts of different scenarios there, Lindsey, in terms of what could go wrong. And I think often the way I would look at it is probably from the other end of the telescope of, if you've got what you perceive as a high value contract and a significant contract for the business, are you actually are you looking at it and negotiating it properly, or having legal advisor doing that for you? Because very often, the contract can be perceived to be really high value, but also therefore really high risk.
Yeah.
So if we use a scenario where you've got a listing with a major supermarket for your brand, you've then got to deliver your brand into that supermarket. What are the payment terms? When are you going to get paid? How much effectively cash are you having to put into that to create the product, to get it on the shelves?
Yeah.
And when are you going to get it back? And what kind of power have the other side, the other party, got to try and either pressurize you or
Yeah, I suppose so. Because if you're a growing business and you get opportunities from a big business or brand, obviously it represents a huge opportunity. But what you're saying is make sure that you've got someone in your camp advising you as to how to minimise your risk, and that it's balanced.
I think it's that balanced argument you've just said there. Using major supermarket comes along. That can be a game changer for lots of small businesses. It can be a fantastic opportunity, but obviously you then potentially at risk of putting a lot of eggs in a basket, as the old saying goes, and maybe that becomes 80-90% of your turnover. So all your whole business is with one customer. That's a big risk. What are the payment terms? So how does that work from your cash flows if you're having to buy stock in and manufacture things? You've got to pay your supplier, you've got to hold stock, and then is it 60 days before your customer pays you? Is it 90? Is it 120? How do you fund that cycle of working capital through that position? So it's not saying, well, there's an opportunity, it's got risk. Let's absolutely grab opportunities when they come, if they work and if you can protect against some of that downside risk.
So again, like you were saying, cash is king, really, making sure that it doesn't put you in a position where you're exposed to a cash flow, which is really going to hand you in a...
I think that point that Si made is absolutely spot on in terms of diversifying the risk with customers and how many customers you got and how exposed you are. So many years ago, we had a situation where a client was, I think, quite exposed. They had a relationship with a very large business, and it paid them very well, and the shareholders are doing very nicely out of it. But even from a commercial point of view, it was you accept these new terms, or the deal's off, and the terms were not nice. And came with all sorts of security in terms of charges over the business, over the shares owned by the shareholders. So this was a horrible place for them to be. And the negotiations were not very nice at all. But there came a point after that last negotiation where they got around the table and went, we are not doing that again. So what they then did was went out and diversified their risk. So that customer wasn't as important to them, and when they could, got rid of them.
Right.
As that business went on, it sold. I would say probably about 4 or 5 years later, and very successfully for the shareholders.
So, what I've learned as a business owner is, you made a point there, Simon, before about saying, you've got to be a decent sized business to be able to employ a dedicated lawyer and finance expert, which obviously is unattainable for the majority of SMEs, isn't it? What's been of value to me is having individuals that I can buy little slices of information from, from experts, almost like a virtual board, if you like. And I don't need a lawyer 7 days a week, but I know enough to know that if I'm signing anything, or if I'm thinking about the direction of my business, I've got an ability to connect with you, Dave, and say, what do you think of this? And similarly with you, Simon, management information for me never existed. I just had an accountant who submitted my end of year. but the ability to be able to turn a light on as to what do these figures actually mean, rather than just having to be compliant for HMRC perspectives, having someone who can advise me on what is going on behind the numbers and what that potentially looks like going forward has been invaluable to me and the business owners that I know who operate in the same way as. So, I mean, my advice is, and I'm sure it would be yours as well, as business owners yourselves, to build up a trusted network around you of advisors that you can tap into.
Yeah.
How would somebody who doesn't have a lawyer or a corporate finance or a management accountant, I know it sounds an obvious question, how would you recommend they do that and find the right people for them, and how do they access that as a small business?
Typically I'd say a small business owner has somebody they trust. So it might be a lawyer they know, or another business owner, or a bank manager, or someone in the business world that they respect, trust, know. Talk to those people. Talk to them first and get their recommendation. I mean, most of the work I do comes from people recommending me, Langtons, the work we do. So I think that connection for a business owner to go to somebody they know, they trust, to say, I need some advice on a legal point, I need some advice on management accounts or whatever it might be.
Yeah. Or do I need them?
Or do I need them?
Yeah.
How do you think? What do you think I need? I think that would probably be my first advice to a business owner.
Yeah.
Just talk to someone you know and trust first.
Yeah.
And then broaden your network through that.
So, in terms of key takeaways for people listening now, what would be the essentials you would say make, if nothing else, by listening to the last 20 minutes or so, think about this? I'll ask each of you individually, what would you say?
From my perspective and from a financial perspective, the old saying of, turnover is vanity, profit sanity, cash is king. I won't necessarily use that phrase, but using that phrase, cash is important, and understanding where your cash flows are. Great opportunities can come, but I've seen that almost bury businesses because they can't actually afford the working capital that comes with that huge amount of turnover growth or the rapid growth they're on. So understanding what your cash is today, what your cash will look like over a period of time is a critical piece. And knowing what comes down the line. We've talked before, Lindsey, around things like corporation tax.
Yeah.
You make the profit in a year, you get those year-end accounts, you're feeling happy, you can see what's in the bank, but there's a 40, 50, whatever £1,000 payment coming down the line for corporation tax, and that can catch people out. So it's understanding what's coming down the line and being prepared. Data, we live in a data-driven world.
Yeah.
And as your business grows, capturing the right data, the data that shows how the business operates, whether it's turnover growth, how that turnover growth is driven, your profitability, understanding that and being able to interpret that data quickly on a timely basis, I think is a valuable piece. So
Thanks,
putting
Simon.
those things in place.
How about you, Dave?
I think it kind of links back to that previous question, Lindsey, that the timing in terms of accessing lawyers in particular is often either when something's gone wrong and you need to react to it, or when there's a positive story and something that you're doing where you actually want protection. So I think for me, you're right, you don't need a lawyer on hand 7 days a week in a small business. As businesses get larger and larger, the same with a finance director or something like that. Would it be better to have an in-house legal or in-house lawyer? Maybe, but it's actually assessing your risks. For me, the key bit is if you think there's a risk and you want to try and manage that risk, then that's the point in time where you might say, actually, we'll engage a lawyer on that specific piece of work. entrepreneurs by their very nature are going to start from a point of view of taking risks. So, and that's what made them successful. And we have many clients who will say, "Yep, I hear the advice, but that's what my appetite for risk has got me to where I am and will take me further in the future." So, but at least understanding the risk and taking a view on what could go right and could go wrong is a very important part of the growth cycle for me.
So basically, just to finish the rounding up there, have the advice you need, know where to go if you need it. So look for your sort of virtual board, if you like, and don't feel like you've got to know all the answers as a business owner, because sometimes we do, don't we? And can be quite a lonely place if you haven't got people experts to ask the right questions at the right time. Thank you. Thanks so much for being here. Really enjoyed chatting to you, and thanks for everything you do, helping me and all the other people I know. Thank you.
Thanks, Lindsey.
Thanks.
Cheers.
Thanks for listening. I hope you enjoyed the show today. Feel free to follow us on our handle @Agnes Marketing on Instagram and LinkedIn. Thank you.